Hello, I'm Michelle Makori. Thank you for joining us. Goldman Sachs is increasingly confident that the U.S. economy will avoid a recession and will successfully pull off a soft landing. The financial giant has lowered its estimated chance of a U.S. recession over the next 12 months to just 15%. Now, a few months ago, it dropped the chances of a recession to 20%. And back in March, as the banking crisis erupted, it had a 35% forecast of a recession hitting over the next year. Well, now Goldman sees a soft landing as a very real possibility, meaning that inflation will be brought down with tighter monetary policy without pushing the economy into a recession. Now, keep in mind that the Fed has only achieved a soft landing once in the past 60 years. Well, Goldman is pointing to cooling inflation, solid job growth, and rising real or inflation-adjusted wages, saying that should allow disposable income to reaccelerate next year. In other words, paychecks will grow faster than prices, giving consumers the ability to keep spending. And that's crucial in an economy where consumer spending is the main driver of growth. Now, Goldman is one of several big banks and Wall Street economists that have been forced to repeatedly postpone or downwardly revise their recession forecasts as the U.S. economy proves resilient. But is it really that resilient? Well, my next guest is warning that we're getting a distorted picture and that the data is misleading, possibly by design. He's forecasting a recession by the end of this year and says that the 2001 default cycle is set to repeat itself, but that it'll be far worse this time. And he's also sticking to his bold call that gold will hit $5,000 within 3 years. Mike Lee is the founder of Mike Lee Strategy. Mike, great to have you back with us on Kitco.
Thank you so much for having me.
All right, Mike, a lot to discuss. I want to focus on your latest report. There you said that the employment data is misleading and that when Fed Chair Jerome Powell describes a robust U.S. labor market, it's really not as healthy as it may seem. But before we get into that in detail, I know you have several charts that break that down. Before we get into that, I just want to get a sense of what your big picture is regarding a recession forecast.
Yeah, so first of all, for a lot of the United States, they're already in recession. If you look at gross domestic income, if you look at federal payroll tax receipts, if you look at traffic at the Port of LA, these things are all already screaming recession. And so those those making under $100,000 in this economy have just been devastated by inflation over the last few years. There's no two ways about it. And the fact of the matter is, inside the last 12 months, we've had 400 basis points of rate hikes from the Fed. That on average takes 18 months to hit the economy with that lag effect. So I can't see things improving from here. And what you heard from Goldman is what you're hearing all across the street, is that the consensus is gone from a recession in the first and second quarter of this year to a soft landing or a no landing. Well, as the consensus was wrong before, I think it's going to be wrong again now. It's just how this can happen. It just defies reason. It defies logic that somehow with this aggressive of moves from the Federal Reserve that we're going to come away unscathed. And you've already seen some massive deterioration in the labor market, although it's certainly not being reported that way.
Okay, so let's break that down, because the labor data is creating an impression that the economy is looking pretty strong, but you've pulled up some charts that indicate otherwise. Go through those charts with us.
Yeah, so the first one I have up is the monthly job change from the original revised and re-revised prints from this year. Every single time a report came out, it was later revised lower. So you have expectations of, say, 250,000 jobs in February. We come in at 311. It's revised to 326 the next month, and then after revised to 248,000. Okay, that has happened every month this year where all these numbers have been revised lower. That is a 12 sigma or 12 standard deviation event, basically meaning you're more likely to get struck by lightning 4 or 5 times on the way to work than this happening. And so you have to ask yourself at a certain point, is this government bureaucracy and is this a flawed model, or is the BLS cooking the books to favor the Biden administration?
Well, hang on a minute there. I mean, it's not that uncommon for data to be subsequently revised, higher or lower, but you're saying that this hasn't happened this many times in a row before. Is that what's making you sort of kind of raise your eyebrows here? The fact that we haven't had that many revisions in a row before?
In every case this year, you have a number that comes in that's magically higher than expectations, and it's later revised lower than what the expectations would have been. So yes, this data moves wildly, right? From every payroll number is revised twice, sometimes up, sometimes down, but to come in above expectations and to end up below expectations in the third and final reading, 9 times in a row is it's a 12 sigma event. So it's really, I mean, part of this, I believe the Bureau of Labor Statistics models are broken. Prior to COVID, okay, you could look at the employment data from August of 2018 and compare it to August of 2016, or from May of 2012 and compare it to May of 2010. And although the exact numbers may in itself be incorrect, there is a consistency to the error. So you could get an apples to apples comparison. I think if you look at the data now to pre-COVID, something's wrong, right? Like so many people came in the workforce, came out of the workforce, got paid to stay at home, got massive stimulus checks from the government that they put on Bitcoin or whatever, or they started their own business or they closed their own business. But the labor force is in such flux. I don't think the Bureau of Labor Statistics has their arms around the situation, and as a result, this data to me is highly suspect. And one other, I'm going to change the screen that I'm sharing right now. To the second one, right, which is the JOLTS number. So if you look at the JOLTS,
and that's job opening and labor turnover survey, just to break down that acronym for our viewers.
Correct. So that peaked around 12 million, right? And now we're sitting in the 9 million range. So we'll talk about the JOLTS. So in terms of the JOLTS, a decade ago in 2013, the survey response rate was 70%. Now it's 30%. And keep in mind, the Bureau of Labor Statistics does a phone survey of 50,000 businesses, not all of them every single month. So what can be the accuracy of that? And you have a response rate from that, and you extrapolate what you believe the rest of the market looks like based on certain assumptions. Okay, if any one of those assumptions in that 1,000-column spreadsheet is off, the whole data does not come out correctly. And so the one I have up here now is the August private payrolls, which kind of hits home on the point that we, this was the worst. So when you take unadjusted private payrolls, this was the worst August since the great financial recession. So when you combine that with the JOLTS falling off a cliff, so you had supposedly had 12 million, now we're at 9 million. That's the fastest drop we've ever seen in the survey. And then you hear it empirically out there, people looking for work are not finding jobs the way that they were, that this wage growth, this real wage growth, particularly with the price of oil reaccelerating, in my view, is a total and complete pipe dream. It's just not something that's going to come into fruition. And a lot of the bull case for stocks is based on massive earnings growth. And this was the trough quarter for earnings for the S&P 500. I simply, I just don't see it.
Okay, so you're calling into question the so-called strength of the labor market. But when you say that the data is misleading, do you think that's intentional? Do you think that the model is flawed? I mean, because eventually people go back and look that the jobs number was revised downwards, or does the market not really look after you have the second or third revision? Like, what do you think is really going on here? Is it by design, or do you think that it's just, shall we call it, inefficiency of modeling?
So at this point, you have to call into question about the design. 6 months ago, you could say, hey, I think the model is broken. But now at this point, with this many data points in a row, all getting revised downwards, coming in the same pattern, right? So you get a beat on the headline versus what the street expects. So that's a powerful headline. That's what most people will pay attention to on Jobs Friday. Right. I always look at the revisions. I don't know how many other people do, but it's, the amount of job growth that we're seeing is obviously slowing. And just an interesting statistic is that, the peak unemployment. So when we're at the lowest unemployment rate is normally about 6 months away from the start of a recession. Right. So, these things tend to deteriorate very rapidly. It's not something that happens in a linear fashion. It's more of like falling off a cliff. And so that's something to watch out for, because as rates stay high, and I think we are potentially going to see some hotter inflation prints either next month or the month after, which means we could get another rate hike at the end of this year, which I think would be a mistake. It shows, in my mind, the fragility of these assumptions and the flaws in these assumptions, especially if we see a reacceleration in inflation due to the higher price of oil.
So in terms of how this jobs data may impact the people that matter, and that's largely the Fed, right? I mean, the Fed is watching this to see how much leeway they have in terms of raising rates. So how does that dynamic work if you're saying that, the data may be subject to misrepresentation? Is that the data that the Fed is looking at? I mean, surely the Fed then takes a look at the revised numbers. The markets may not be paying attention to the revised numbers, but one would think that the Fed is checking those and digging deeper into the data to see if it does have room for more rates. What does this mean from the Fed's perspective?
Maybe, but the Fed needs unemployment to spike. They can't. The Fed wants to see a 6 or 7% unemployment rate. They're not going to say so, because they need to kill inflation. And if Jerome Powell had to choose between not raising enough and raising too much, because there's like basically a 0% chance he's going to get it exactly right, he'll go for raising too much. And he said that on numerous occasions, because look, inflation is not only bad for markets and economies, it destroys societies, right? It is a hidden tax that unwinds society at its fabric. And that is why that is the number one priority of the Federal Reserve. They, in large part, look, you can see by the way that they acted. They printed too much money. They took too long to take action against it, and now they need to overcompensate. And they're very clear, if you listen for it, about the interest in overcompensating. So the Fed, it'd be awesome if they got a soft landing. I just don't see how it's possible as we start to have a default cycle pick up. You start to look at things like the new car loans. The average new car loan is like 9.25%. Right, that's absolutely wild. All right, the 10-year, like we're getting back to high 7.5, 30-year, 8%, 30-year mortgages, depending on where you are, and like whether it's an agency backed or it's a jumbo. These things slow the economy down. Credit card rates all-time high. Credit card lending. All-time high. So we'll just take a look at this.
Before you pull that up, and that's going to actually lead into the rebuttal, I assume, of the Goldman Sachs report, which I want to draw your attention to, because as I said, Goldman Sachs issued this report titled Soft Landing Summer. They're pointing to a series of encouraging economic indicators on inflation, the jobs market, that say that a recession is becoming less and less likely, lowering the odds of a recession to 15%. Here's what Jan Hatzius, Goldman's chief U.S. economist, wrote. In this report, we strongly disagree with the notion that a growing drag from the long and variable lags of monetary policy will push the economy towards recession. In fact, we think the drag from monetary policy tightening will continue to diminish before vanishing entirely by 2024. And they're pointing to the solid job growth and rising real income, or as they call it, inflation-adjusted wages. And they say that should allow for more disposable income to reaccelerate next year. So in other words, you'll have paychecks that will grow faster than prices, faster than this inflation, giving consumers the ability to keep spending. And of course, that's very important in an economy where consumer spending is the main driver of growth. So what do you say to that, Mike?
I hope he's right. I just don't see how it's possible. I just put up another chart. It's credit card debt. We are at absolute all-time highs. And then we'll go to the next one. If you look at the rate of change in delinquencies on credit card debt, like you're already there. There's a large portion of America that's completely tapped out, right? And it's as you start seeing more and more corporate defaults. See, once a few major companies start to default, right, and you're already seeing this from the SLOSS, the Senior Loan Officer Survey. I'm forgetting what one of the O's means, but basically, how much are banks willing to lend? That's tightened up dramatically, right? And so that's really starting to creep into the economy. And if you can get a loan, it's at like an ungodly interest rate. So that's really starting to kick in. And it's, you typically need about 18 months into the inversion before unemployment, the wheels really start to come off in unemployment, which puts us towards the end of this year. I know sometimes some cycles have been before it, some cycles have been after it, but we've never had an inversion like this without some sort of recession. They say every time is different. No time ends up ever being different. And I don't believe, like, if unemployment pops up by 100 basis points, how on earth are wages going to continue to press higher? It's just, it doesn't. All these trends are in the other direction. And then the other one is the leading economic indicator index has been in decline for 15 months in a row. It's like the soft landing camp, the no landing camp, want you to ignore all this historical precedent. And like, look, I hope they're right. It'll be better for me. It'll be better for my clients' portfolios. But I don't know how it's possible. But then again, I'm not some fancy guy from Goldman Sachs.
Well, that's why we want to hear from you, Mike. You're the voice of the people, right? An informed and educated voice of the people. But it's interesting because you mentioned debt. We have credit card debt levels surpassing $1 trillion for the first time ever. And that's according to the Federal Reserve Bank of New York. Second quarter alone, credit card balances surged by $45 billion. And yet, it's not just Goldman Sachs. JP Morgan, Bank of America, also echoing a similar sentiment. They're also revising their recession calls for this and next year, saying that people are employed and they're spending money. We heard from the CEO of Bank of America, Brian Moynihan, and he says the firm reversed its prediction for a recession in the coming months because of the strength in the job market and the robust consumer spending. I'm quoting him here saying, people are employed, they have money, they're spending money. Now, consumer spending makes up 70% of U.S. GDP. So, what do you make of that we've got these big Wall Street players now saying we've got a strong consumer?
Look, Redbook, same store sales, they were in decline for the first time since the COVID. We had some weeks of decline. Let me see if I can get this up here for you. Okay. As you can see, we've had a snapback in the last couple of weeks, but you saw in July we had declines year over year. You look at that. So even though we're up 4% year over year, that's a Redbook same store sales index. That is not what that is large chain stores, both online and in person. How is their sales year over year? To me, it's a more accurate measure than the retail sales report because there's no seasonal adjustments. So you ask yourself, like, how do we have those declines? And yes, maybe there's we saw a little bit of a kickback here, but adjusted for inflation, that's flat, right? And like again, you go to the payroll withholding, tax withholding, you're negative year over year. So adjusted for inflation, that's down massively. And if you look at real interest rates where the Fed was prior, like we've had a 10% move in real interest rates from inflation to tightening. So it's because inflation was at 8-9% in the middle of 2021. Interest rates were still at zero, and now it's moved massively in the other direction. So how does an economy withstand that? And these things don't happen overnight. So look, maybe next quarter we'll get rosy earnings. I'd imagine all these massive banks are going to make a lot of money because they pay their depositors zero, and the Fed is paying them 5.25% or 5.5% to park their deposits at the Fed. So that's been the earnings driver for a lot of these major banks. JP Morgan, the major earnings driver, has been First Republic, basically getting them for free and monetizing all their loans, all their deposits. And that's played a huge role in the last 2 quarters of earnings for the S&P 500. Until the Fed cuts on the front end, I can't imagine that changes, and that will paint over a lot of the picture. But look, the ISM manufacturing index has been in contraction for well over a year. The new orders index, my favorite leading indicator, has been in contraction for well over a year. You're like at 14, 15 months. Housing, it slowed last year, reaccelerated in the end of last year, and just again has screeched to a grinding halt. There's a huge multiplier effect to the lack of construction in new homes, mortgage rates ticking up, because the home builders also need to lever up to build their homes. So even though the cost of materials has somewhat normalized, you still need to borrow at exorbitantly high interest rates to buy homes, and the consumers need to buy at exorbitantly high interest rates. So that I just don't see how these real wages continue to grow as this labor market softens up.
Well, here's what JP Morgan has to say in terms of why it's revising its recession forecasts. And keeping in mind, JP Morgan was wrong, right? They previously said they expected a recession to begin in early 2023. So it's not like they have a record of being correct here, but nonetheless, they see continued expansion this year and modest subpar growth in 2024 as the most likely scenario. This is according to Michael Feroli, JP Morgan's chief economist. In the US, flagging the rising possibility of healthy non-inflationary growth thanks to potential productivity gains from artificial intelligence and a pickup in labor supply. It may be a little early to be touting artificial intelligence here, but that's what their note says. The likelihood of a contraction has diminished in recent months. A relatively quick resolution of the debt ceiling has taken one type of financial crisis risk off the table, while regulators' implicitly guarantee of bank deposits has vastly reduced the odds of a different type of financial crisis risk. So what do you make of that?
Well, he's definitely right about the Fed and stemming the tide of bank failures. And I'm shocked we haven't seen a bunch more bank failures in the moment. I don't know what the impact of AI will be on productivity. At some point, it will be massive, right? It will be many menial jobs, or one individual, like where it takes 8 people in an department to do certain things. All of a sudden, it's going to take one, and it gets done better and faster, right? So that's that, and then every time we've had a major technological advancement like this, it's led to newer, higher paying jobs. So I don't think the AI is out to replace us. I just don't know that it's here yet. So look, people started calling the housing crisis in 2005. Right, that's when people started talking about the bubble and the problems with Fannie and Freddie. And if you remember, The Big Short with Michael Burry, in 2006 when he had those negative bets, investors tried to pull their money, and he kept the gates up only to make a zillion percent in the inevitable crisis. I just think a lot of these calls were early, and they underestimated the amount of liquidity still out there. If you look at the chart, I unfortunately don't have it up with me, but it's the inflation cycle from the early 1980s to now, and it's a double top. And like this inflation cycle is following it exactly. So if we get some hot prints and the Fed raises a few more times, what do you think is going to happen there?
Right.
I can't see a re-acceleration of growth from here in either earnings or the economy, because we're slowly but surely coming to a grinding halt. Higher levered companies are going to have greater and greater trouble refinancing, and it's this default cycle, this default wave, I believe, will lead us to this next recession, which I don't know to be as devastating as 2008, but to me, it is also unavoidable.
Okay, a lot to unpack there. Firstly, elaborate on what you mean by this default cycle. You're saying we had a really bad one in 2001, but you think that this one could be even worse. Unpack that for us.
Well, so in 2001, it wasn't massive on par with 2008. Right. So I would say this recession, in my mind, would mirror that of a 2001 recession without 9/11. So we were already entering recession going into 9/11, and that certainly accelerated it. Right. So the nature is that once every 6 years, companies get over levered, they get cocky, they overexpand. The Fed, as the economy is overexpanding, the Fed raises interest rates to slow down growth. Higher levered companies have a tougher and tougher time refinancing their debt. Once they default, there's some liquidations, layoffs. And as they start laying off people, as the labor market starts to deteriorate, spending declines, and it causes more and more defaults until the Fed finally cuts. And then we start all over again. And you need those default cycles to kind of clean out the bad companies. And so you don't end up with a bunch of zombie companies. And I believe the Fed is making a mistake with their bank liquidity programs, because the whole point of quantitative tightening, the whole point of this rate hiking cycle was to flush out the excess, right? So everything they've done on the quantitative tightening side, they've undone with their bank guarantee and bank liquidity programs. So it's taking longer and longer to get there, but I still don't see how we avoid it.
Okay, well, let's talk about the Fed and what your expectations are. We heard from Jerome Powell at the Jackson Hole Central Bankers Summit, and the message there was pretty much higher for longer, that expect that to be the norm. He was saying that he's committed to getting inflation to 2%. He even warned that additional interest rate increases may be needed to get there. So with regards to the next meeting, the latest rate hike expectations, according to the CME FedWatch tool, say there's a 93% chance of the Fed pausing in September and a 47% chance of another 25 basis point hike at the November meeting. Do you agree?
Well, look, so they're definitely not going to raise in this next meeting. Okay. But then you start moving forward with basically 50-50 odds of another 25 basis points. And so to figure out what the Fed is going to do, I am watching oil, because as we saw inflation decelerate, it was first the producer price index that fell before the consumer price index, right? And if you read the responses in the PPI, it was the dramatic lowering of the cost of energy, not only from reduced demand, but from the Biden administration dumping the Strategic Petroleum Reserve. Okay, that's ended, and now you basically declared economic war on a lot of oil-producing nations. You've declared Mohammed bin Salman in Saudi Arabia, this terrible murderer, and blah, 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 blah. And whether he is or he isn't, it's a conversation for another time. But he has a huge amount of control on the price of oil. And then obviously everything that's going on with Russia and the way the U.S. has weaponized the dollar and every sanction known to man against them, that has led to a surge in oil to where you could see $105, $110 a barrel. As that flows through the system, obviously, it's taken out of the PPI number and the CPI number, but the cost of energy affects everything. It affects everything that we do. And so with structurally higher energy by 30 or 40% going into the fall leads me to believe that 2% inflation is nowhere near here. And in fact, inflation in itself could reaccelerate on the backs of what they've done for these banks, right? Not taking them out, not letting more banks fail, getting that excess liquidity and that junk out of the system, as well as the cost of everything just going up because it's harder to put things on trucks. It's harder for people to fill their gas tank. It is a massive inflationary pressure on the economy.
Right. And we've seen Saudi Arabia saying that they're going to decrease output, maintain that, so putting more strain on the oil market. But, Mike, the big picture is most people are saying maximum. The Fed has what? At best, one more point, if that. Like they're not seeing an increase by more than 1 percentage point, and that's on the very, very high end of the scale. Do you agree with
that? That's the view right now, okay? And if the price of oil corrects, or because of other economic slowing, or the labor market deteriorating, inflation does not tick back up, I would say, you're probably the better bet out of the 50-50 odds. We get zero, right? We have no more hikes, right? Because again, 400 basis points in the last year, right? So since September of last year, the Fed has raised interest rates 400 basis points, okay?
Right.
Off level of 1.5, 1.25. That's never, these proportional increases have never happened. And for something not to break as that goes along, again, you're basically, we're betting on like Bigfoot and the Loch Ness Monster, like taking over.
Well, speaking of breaking, we started to see signs of breaking with the banking sector. And now you've said, the Fed coming in and basically guaranteeing that there isn't going to be a bank run with assuring depositors that has, nullified that. And last time you were on, Mike, you called the end of First Republic. It was in May, a couple of days before regulators seized First Republic Bank and sold off its deposits and most of its assets to JP Morgan Chase. You said this is going to happen. You said that you do not see a scenario where in the next couple of days, First Republic emerges as the same First Republic. And in fact, you were correct. It did go under. It was the second biggest bank failure in U.S. history. So, and obviously earlier this year, we had the collapse of Silicon Valley Bank and Signature Bank. So the thinking has been, the Fed is going to break something and that's what's going to stop the tightening. But you're saying now that we have these deposits insured, that's less likely to happen. And in a way, it negates the efforts of the Fed. Is that correct?
Yeah, absolutely. You need these bank failures, these banks that you don't want to see it from deposit runs, but banks that were too risky, you need to clean them out of the system. Okay. And the unbelievable, crucial mistake of this cycle was bailing out Silicon Valley Bank. And it had a lot more to do with who the depositors were, i.e., the richest and most powerful people in this country, than keeping the system sound. Right. The amount of depositors they had over the $250,000 limits, the amount of deposits that represented their deposit base over the $250,000 limit was like 5 to 10x the next bank, and like 10 or 20x the average bank in the US. So now that they've gone in, they've put together all these programs, every bit of dollar they've tried to take out of the system with quantitative tightening, they've just put back in with all these programs where you can post bonds that are trading at 60 cents on the dollar and get $1 back, right? So it's this liquidity that they put in the system to short these banks. I mean, it's on one hand, you stem a bank run in a banking crisis. On the other hand, you just kick the can down the road. And what needs to happen for this inflation to stop is to get the excess liquidity out of the system. So on one hand, you're trying to take it out. On the other hand, you're putting it back in, all for political reasons.
Okay, yeah, political reasons. And that's a whole other factor that we need to get into. But let's just finish your thoughts on the banking sector. Are you concerned that there will be more bank failures?
No.
No.
Not really. Because of these programs the Fed has together. In fact, there's one bank I really like. It's Truist Financial, TFC. The stock trades at like a 7 multiple with a 7 dividend, and it's trading at between 2/3 and 70% of book value. The historical multiple for that company is like an 11 or 12. The book value is 1.1 to 1.2. So Truist trading between 30 and $32. I'm not exactly sure where it is right now. You see that stock trade at 45, no problem. Over the next few years, you get paid 7% to wait. And it's the 5th largest bank in the United States. So just outside the money center banks, but still a massive bank. So, some of these, there's some opportunities in this banking sector for investors I'd be on the lookout for. But, you have this looming commercial real estate crisis, which is just the nature of that beast, is it's just going to take a long time to play out because of the equity one needs to put up and the profitability of those loans versus a mortgage loan. So I don't know that that's going to cause a crisis, but there's a lot of people sitting on unrealized, unrecognized, non-mark-to-market losses. But that will play out time. I just see lending getting tighter and tighter and tighter. And capital getting restricted in the economy so that the default wave begins. Once you start having defaults, that leads to less spending and more defaults because company A fires a bunch of people, defaults on its bond payments, and stops paying vendors, right? Those vendors, are feeling it from every which direction. All of a sudden, they can't make a bond payment. They default, the same thing. And so you have a cascading effect that we're already starting to see that I see accelerating into the end of the year.
And yet you're not that concerned about the banking sector per se?
No.
Okay.
No.
Let's talk about the markets here, okay? Because going into this year, people were forecasting a recession, and that made people a little skittish about getting into U.S. equity markets. And look, S&P 500 has been down lately, but up still 17% year to date. So what does this mean in terms of your approach towards equity markets if you do see this recession kicking in the fourth quarter?
Yeah, so I'm absolutely dumbfounded by stock markets this year. Historically, when you have tightening liquidity, slowing economy, declining earnings, you have price to earnings multiple contraction. Okay, from November to the middle of July, you had price to earnings multiple expansion by close to a third. And a lot of this has to do with the Magnificent Seven. And some of that, I would say, is those stocks were overdone in terms of sell-offs towards the end of last year. So, bounce back was warranted, and now they've gotten to some stretch valuations based on the hopes of artificial intelligence. Well, the only company that showed us any real earnings power from artificial intelligence is NVIDIA, right? Because the way that you need to understand stocks for the next year, the way that you need to understand NVIDIA is that artificial intelligence doesn't happen in linear growth. It happens in exponential growth. It takes a long time to build up, and then boom, it's here. So with the best way it was explained to me is it could take 3 or 4 decades for AI to replace one doctor. It will take another year to replace all of them. So once it's here, it's here. And so in the case of NVIDIA, okay, their chip suite they sell, their data center suite that they sell, that is the leader in the marketplace. And you now have gone from $6 billion in revenue to them guiding to $16 billion in revenue inside of 6 months, right? To the point where they're going to, most likely make $8 or $9 billion in profit in the third quarter, while in the first quarter they were doing $6 billion in revenue. So that sort of exponential growth I expect to continue. And while that thing is happening with the biggest companies, and there's a Google element that's playing along with it, along with Microsoft, and everyone seems to just love Apple right now, it's very much in favor, as long as those stocks hang in there, right? And I expect NVIDIA to keep racing. That's going to mute any real downside to the overall indices. And I think more of this kind of disconnect of fundamentals and the economy, that can continue for an extremely long period of time. So what's the saying? The market can remain irrational far longer than you can remain solvent. And with everybody bearish in the beginning of this year, we saw a massive short squeeze, a massive gamma squeeze. And on the back of that, you've seen some momentum and then some real data, some real numbers, a turnaround at Facebook that led to their stock taking off and tripling. Tesla stock, you got down to like Tesla to like 30 times earnings, which is unbelievable because revenue's growing at 40%. Okay, that stock has since more than doubled since that happened. But some of these stocks were actually cheap earlier this year. I think they're overbought now. And my best guess is that we'll be in a choppy but somewhat flat market until the election next year.
Okay, so we'll get a recession by the end of this quarter and into early next year, but you're expecting a flat market, not a crazy correction in terms of U.S. equities. With the idea of an election, obviously a recession is not popular. Now, to be clear, when you say recession, you mean the technical definition of a recession as in 2 quarters of negative GDP growth? Is that what you mean when you say you see a recession happening?
Yeah, I'd imagine it's the first and second quarter of next year or the second and third quarter of next year.
Okay, of a negative GDP growth, the technical definition of a recession. It will be a very unfavorable look when you have an administration that's touting Bidenomics as a success. So what do you think is going to happen in terms of Fed response? Does that put some pressure on the Fed to cut rates? Now, granted, the Fed is supposed to be apolitical and shouldn't be paying attention to what, the Biden administration or any administration has in mind. But how do you see those dynamics playing?
Yeah, but I'd imagine that by the middle of next year, we've had multiple rate cuts, right? It just, I can't see. And, the Fed could continue to play politics. But the problem is it's the working class of this country. Those that make less than 100,000, less than 50,000, they're disproportionately represented in the electoral college, the working class. And so Bidenomics has been particularly brutal to that class of people, which is why they're grasping for straws and why they're trying to throw the guy ahead of them in the polls in jail. Right. It's very obvious once you get to the granular level. OK, you're now like, so everything that they try to do to stimulate the economy will be inflationary. And if you're a husband, wife, and you don't own your home, you each make $50,000, $60,000 a year and you have a couple kids, these last 2 or 3 years have been unbelievably devastatingly financial for you financially. OK, maybe I'd imagine your credit card debt is racked up. It's a struggle to buy groceries. And now in the next 6 to 9 months, if you might lose your job, tell me who you're thinking about voting for. So, they can pull out all the stops and you can start stimulus that may make stocks do well. But if you cut rates massively and you try to send money out into the economy, what's that going to do to inflation? Right? Like we play, you've played every game there is to keep the music going. When in reality, like you should have just broken the record, paid the piper and moved on to the next cycle. But the second and third stimulus packages passed by this administration and the Fed continuing to print money into 2021 will ultimately be the undoing, in my opinion, of this administration, because that's what's responsible for the inflationary supercycle we're in right now.
Okay, so to recap, you see a recession in earnest, as in 2 quarters of negative GDP, either by the first and second quarter of 2024, second or third quarter. You see the markets remaining flat, and you see the Fed implementing a number of rate cuts in 2024, and keeping in mind that this will all have an impact on the political landscape. So what should an investor be doing? And this is not financial advice, but how are you positioning portfolios in order to best be prepared for the scenario that you're playing out?
Yeah, I mean, this is one of the most difficult periods to invest I've ever seen. So for me, I'm looking at a lot of alternative investment strategies, asset-backed lending funds that are paying double-digit yields. In terms of a couple individual stocks that I like, I really like NVIDIA. I've never seen anything like this in my life. I think Truist in itself is cheap, but the XLK, the tech sector, that is dominated by these massive names. And I think in these times of crisis where interest rates are so high, and you have a particularly regulatory friendly administration, the moat around a Microsoft, the moat around a Google gets bigger and bigger and bigger. And so that, you can find safety in those big names, right? Because, the way that Google is growing and the advancements that they have in quantum computing, plus of all their different tentacles and everything, it's actually kind of a cheap stock, especially relative to the other Magnificent Seven. But in that type of market, obviously, the way that I'm playing gold for my clients right now is buying an ETF called IGLD. It writes covered calls against GLD inside of it, so it produces a 7 to 9% yield. So that, if you're stuck waiting in gold and we don't get this breakout that I think we need, I think we should have had, you're paid to sit there and wait. But in this recessionary situation, particularly with the likes of China looking really ugly, with Europe looking really ugly, there is going to, at some point, there's going to be a flight to safety. I think that pushes gold higher, and then we're off to the races.
Okay, let's expand a little bit more on your gold call. Last time you were on, you made a call for $5,000 gold in 3 years, right? You've mentioned a number of factors that could impact that, but how do you see gold getting there?
Yeah, so if we have another breaking event, something like a Silicon Valley Bank, and it won't be something like that, it'll be something else. Then all of a sudden you get above 2,000 and you really start moving. But this continuous slowdown of the economy. That being said, one has to wonder how it's not already materially broken out above it, given the amount of buying that a lot of these BRIC nations are doing. At the moment, that gold has not broken out materially above 2,000 and it's on its way. So, maybe as we saw with silver, and you're finally seeing some JP Morgan traders go to jail for what they did, 15 years ago in containing the price of silver. Is there something like that going on in the gold markets to artificially deflate the price? Because, when all these stars line up, and the price of something should be much higher, or you have a 12 sigma event as we do in the jobs numbers, your mind just goes to these conspiracy theories because so many have become true over the last few years.
Yes. Yes. What is that saying, that a conspiracy theorist is just someone that has the information before you do? Yes. I believe. I don't know if I'm paraphrasing that correctly. All right, so that's your thought on gold. You did touch on, obviously, the BRICS development. We did see them expanding by adding another 6 members. It wasn't quite the development that people were expecting to come out of that summit, but I do want to get your thoughts on some of the geopolitical developments that we've had recently and see if that has any kind of impact on gold. We have tensions between Russia and the U.S. intensifying. Russia's issued a warning this week saying that it'll treat any U.S. attempt to station nuclear weapons in the U.K. as an escalation. And there were reports that the U.S. was planning to deploy bombs on British soil for the first time in 15 years. We also know that North Korean leader Kim Jong-un may be traveling to Russia for talks with President Vladimir Putin, talking about possible sale of arms to support the war in Ukraine for Moscow's end. So what's your read on that, keeping in mind we have a war in the background here? How do you see those geopolitical tensions escalating or not, and what that could mean for gold?
So remember, we were told when Joe Biden showed up, now the adults were in the room. And if you look at every hotspot in the world, it's materially deteriorated. So like I would say Anthony Blinken is fundamentally incompetent in that this administration has no plan. They're immature children who kick and scream and throw their toys when they don't get their way. Fortunately, some of these other players understand what's at risk, and so I don't see a nuclear war on the way. I'd see a slow grind of continued deterioration in Ukraine, a more more blood, more kind of muted fighting where Russia takes slowly but surely more ground in Ukraine. But I don't think they're looking for an acceleration. To me, the key mover for gold out of all of this would have been this BRICS meeting. And so just as an aside, what's going on with these BRICS is not an attempt to replace the US dollar. It's just to weaken the sanctioning power of the United States government so that any of these countries can do business with whoever they want and not have to worry about the United States weaponizing the US dollar against them. So it's bad for the US, but to take down King Dollar, it will happen one day, not kind of in these next 18 to 24 months. I'd say geopolitically, what's more likely to help gold is the fact that, we were told like we were going to have a $1.3 trillion deficit in the US, but it's going to be closer to $2 trillion, right? And so the fall off of tax revenue in the US and this excess spending, right? That sort of thing, I think, is more bullish for gold than kind of all these flare-ups elsewhere. Unless something goes off the rails, but how long ago did this Ukraine war start versus where we are now? I can't see that happening now. It just doesn't fit the pattern of events. It's not an impossibility. I guess Rocket Man now wants some Russian missiles. But again, these are, those to me are more sideshows that aren't going to have a material impact. I'd say it's the only the U.S. budget deficit is a geopolitical event, right? Because the U.S. dollar, people think about the U.S. dollar as a reserve currency, fail to think about not only the fact that there's no other global bond market where people can park their excess reserves, but the size of the euro dollar market, which no one really knows what it is. And so for your viewers that don't know, the euro dollar market is dollar denominated debt that originates outside the US. Okay, that could be 10 trillion, it could be 15 trillion, it could be 5 trillion, but that's a common use elsewhere in the world. So for the dollar to be replaced, you need another bond market to emerge and another stable currency that can replace all that. And yes, that will eventually happen to the US dollar, but I just don't see it happening in the next few years and maybe not in my lifetime. It will eventually happen. All currencies fail, but the purchasing power destruction of the US dollar is going to continue to happen without fundamental change in the United States government. And I just don't know. There's another thing that I don't think will happen in my lifetime.
Okay, so the dollar will not be dethroned in Mike Lee's lifetime as the king of global reserve currencies. But as you're saying, these BRICS and their alliance may deter the U.S. from using the dollar as a weapon to influence political change globally, which kind of brings up the point of what's the alternative. If they want to influence change, does that mean military action? But that is a conversation for another time. Final thoughts, Mike. Just want to get your outlook on Bitcoin as we wrap up here.
Oh man, I love it. Look, so BlackRock, even though they're a passive investment firm, right? And so people talk about their share ownership as if they control all these companies. These are in passive funds. They're in ETFs and index mutual funds and people's 401ks, but they are juiced into this administration. They have filed for a Bitcoin ETF, all right, with the Ethereum loss and the grayscale loss the SEC faced in court. Once that Bitcoin ETF gets approved, it's lookout, because it becomes a million times easier for people with real money to be able to buy it. And so most of my clients are in their 60s and 70s. Okay, they're not going to figure out how to open a wallet at Gemini or Coinbase, but if I can buy them $1 million of a Bitcoin ETF, they're all in. So once that starts to happen, that's a fundamental change for Bitcoin. I'm not sure how it's going to play off other cryptocurrencies. But for Bitcoin, I have children's wallet set up for all my kids. So for my kids, I own a bunch of gold and I own a bunch of Bitcoin.
Okay. In terms of a near-term price forecast for Bitcoin. We have Pantera Research saying that they expect the next halving to see Bitcoin rising to $35,000 and before the halving, and $148,000 after. Right? So they're targeting a $150,000 price point within approximately 480 days after the next expected halving, which is April of 2024. So I guess that means by 2025, middle of 2025, end of 2025, they're seeing $150,000 Bitcoin. What's your take on this price forecast?
Well, like, the history of Bitcoin is you triple your previous cycle highs. So that would put us closer to 200,000, right? And so here, I believe it was the failure of FTX that pushed us below the previous cycle highs, but we immediately recovered. And then Silicon Valley Bank was a seminal moment for Bitcoin. It's the first time that Bitcoin rallied in a risk-off event. Right. So if you go back and look at the timing of that, how much Bitcoin rallied, and you basically moved from 20,000 to 30,000. And now there's some aggressive sellers out there that seem to want to beat it up on a daily basis. I'd imagine that has something to do with positioning for ETFs that are going to get approved. But if BlackRock's filing for an ETF, I would say, with the tentacles they have in this administration, that something is likely to happen. In terms of that being approved, and it'll be widely approved. And so, once that goes through, I would look for Bitcoin to make a jump from roughly 30,000 back up to 60 or 70,000. And then once we break through there, you're at your next cycle repetition up to about 200,000. So look, I'm like, the point of the Bitcoin is there will only be a limited amount of Bitcoins, while there will be, there could be an unlimited amount of US dollars. And, people that say it's not an effective inflation hedge, tell me what you could have bought for $6,000 in 2019. Well, I could have bought one Bitcoin. Okay, what does $6,000 buy you now versus what does one Bitcoin buy you now? Well, one Bitcoin's 25 grand now, and I can buy a lot more with one Bitcoin than I can with $6,000 had I just held on to it, even at a savings rate of like 4 or 5%. So it is not as mature an asset class. At some point, it will get to a tight trading range. I don't know when that's going to be, but I think the best days are far in front of Bitcoin.
All right. Well, we will leave it on that optimistic note for Bitcoiners. Mike, thank you so much. Really appreciate getting your insight on such a vast array of topics. Look forward to having you back on. Thank you so much, Mike Lee. All right. And thank you, as always, for watching. For me, Michelle Makori, and the rest of the team here at Kitco. We'll see you next time.